Everyone, in today's presentation on the efficient market hypothesis, we'll explore into one of the cornerstone theories in finance that has profound implications for investors, analysts, and policymakers alike. Let's explore the key concepts, implications, and criticisms surrounding the EMH, or we call it efficient market hypothesis. The first one we will understanding the efficient market hypothesis. So the efficient market hypothesis posits that financial markets are informationally efficient, meaning that asset prices reflect all available information. In other words, it suggests that it is impossible to consistently outperform the market by exploiting information or analyzing past price movements. And there is no such thing as undervalued stock or overvalued stock. There are no differentiation of price and value. Both are the same thing. Therefore, nobody can be the market and they should just invest in index fund. The next one we will discuss the three forms of EMH. The first one is the weak form. In the weak form of EMH, asset prices reflect all historical price and volume information. Therefore, technical analysis which relies on historical price patterns is deemed ineffective in generating abnormal returns. The second one is semi-strong form. The semi-strong form asserts that asset prices reflect all publicly available information, including historical data and publicly announced news. Consequently, fundamental analysis, which involve analyzing financial statements and economic indicators, is unable to consistently beat the market. And the last one is strong form. The strong form is the most stringent form in EMH, suggesting that asset prices reflect all information, whether public or private. Even insider information which is not available to the general public is assumed to be already incorporated into asset prices.
Third is implication of EMH. Investment strategy. EMH has significant implications for investment strategy. It suggests that active trading strategies such as stock picking and market timing are unlikely to consistently outperform passive strategies such as index investing or buy and hold strategies. Next is market efficiency. EMH implies that financial markets are highly efficient in processing information and incorporating it into asset prices. This efficiency promotes market liquidity, reduces transaction costs, and facilitates capital allocation to its most productive use. Next is policy implications. From a regulatory perspective, EMH underscores the importance of transparency and fair disclosure practice to ensure a level playing field for all market participants. It also highlights the challenge in detecting and prosecuting insider trading activities. Fourth is criticism of EMH. Behavioral biases. Critics argue that EMH overlooks the role of investor psychology and behavioral biases in driving market inefficiencies. Behavioral finance suggests that investors often exhibit irrational behavior, leading to mispricing of assets and opportunities for profit. Next is market anomalies. Empirical studies that identified various market anomalies that seem to contradict the predictions of EMH. For example, include the momentum effect, where past winners continue to outperform, and the value effect, where undervalued stocks tend to outperform over time. Next is information asymmetry. EMH assumes that information is freely available to all market participants, but in reality, information may be asymmetric, with some investors having access to privileged information. This information asymmetry can lead to market inefficiencies and unfair advantage.
Okay, so in this part, we will talk about the investor perspective on the efficient market hypothesis. So in efficient market hypothesis, they believe that the price that is currently traded in the stock exchange is fair, and therefore nobody can beat the market, and therefore they should just invest in the index. But there are some kind of investors that are consistently beating the market in the long run. And most of these investors are called value investors. Famous value investors like Warren Buffett, Charlie Munger, Lilu, Peter Lynch, and in Indonesia we have Lo Keng Hong. Price and value is not the same. Price is what you pay and value is what you get. If EMH is right, that means there are no undervalue or overvalue stock. If the stock goes up, you know more than the market, and if it goes down 10%, you feel the market knows something and you don't know about the business. It means you have no conviction. It is ridiculous that the value of a company changes every day. So why are there a condition of undervalue and overvalue stock? It is all about fear and greed. Most humans in the market is not rational, rather emotional. Even with one same information, 10 people can act differently. And the academics community called Buffett are lucky investors, and it's not about skill because no one can beat the market. So let's see what Buffett thinks about efficient market hypothesis.
I would say investment teaching in this country in general is kind of pathetic. What you really want a course on investing to be is how to value a business. That's what the game is about. If you don't know how to value a business, you don't know how to value a stock. And if you look at what is being taught, I think you see very little of how to value a business. And the rest of it is playing around with numbers or Greek symbols or something of the sort, but it doesn't do you any good. I mean, in the end, you have to decide whether you're going to value a business at $400 million or $600 million or $800 million, and then you compare that with the price. That's what investing is. I don't know any other kind of investing to do. The reason it isn't taught is because there aren't teachers around who know how to teach it. And since they don't know themselves, they teach something that says nobody knows anything, which is the efficient market theory. And if I ever teach physics, I'm going to come up with a theory that nobody knows anything. It's the only way I can get through the day. I mean, you get in the finance department because you sign on to whatever the present group thinks. And if they think the world is flat, you better think the world is flat too. And your students better answer that the world's flat when they get it on exams.
Belilah perusahaan-perusahaan yang valuasinya murah, contohnya ini ya. Ada Penin Finansial, labanya 9 bulan 43 sekian. Kita setahun kan 60 rupiah. Kalau harga sahamnya 200 sekian ya, PI-nya mungkin 3,7 kali. Price earning ratio 3,7 kali. Ini ada perusahaan namanya Poluk ya. Labanya hanya 4 rupiah per saham, 4 rupiah. Harga sahamnya berapa ya? 9.000 lebih ya. Kalau disetahunkan jadi 6 rupiah. 6 rupiah harga sahamnya 9.000 lebih. Arti PI-nya 1.600 kali. Kalau labanya tetap 1.600 tahun baru break even loh. Belilah perusahaan yang valuasinya murah, bukan yang PI-nya 1.600 kali, bukan.
Okay, so in this part, we will talk about a real case that is happening in the Bursa Efek Indonesia. So the first case is the overvalue case. When a stock is trading at higher value than what it's worth. So in 2022, PT Bank Jago market cap reached over 100 trillion rupiah. It's higher than BNI market cap. With 100 trillion rupiah in market cap, they can only earn 120 billion rupiah. In other words, their price to earnings ratio is 1,000 times. To justify that 1,000 times PE ratio, they should better be growing at 100% compound rate in 5 years to achieve 20 times PE ratio if that's their fair PE ratio. If a human is rational, they must have known that 100 trillion is not fair for Bank Jago, so it's definitely overvalued. The rationale behind this phenomena is the market expect from the information that digital bank is the future. But is it rational just because of that one information Bank Jago is worth more than 100 trillion rupiah? But in EMH, market is efficient, so they don't worry and just buy the stock. It is a waste of time to value the business. Okay. For the second case, when the stock is undervalued. In 2021, everyone have the information that the coal price index is at $100 a ton. And the coal company will make a lot of profit out of that because the cost is about only $30 a ton. Depends on the coal calorie. So there is a huge margin to profit. So I bought Indo Tambang Raya at 15K, but nobody want to buy that stock at that time because of the information that issues about the ESG and environmental issues, which that doesn't make any sense. People still use coal for electricity, so it's the cheapest and the most efficient energy to produce electricity. So the market is stupid and not efficient. And when the market led realization that Indo Tambang Raya is cheap, I sold at 40K. So this is the proof that even with one same information, which is the price of the coal, people still act differently. So for the conclusion, the market is efficient, but sometimes it's inefficient. The market can only be efficient if all the humans that buy stock is rational and not driven by emotional. The market is sometimes efficiently, mostly in the long run, but in short run, it is mostly not efficient, and you can find opportunity in the stock market. Benjamin Graham said this wisely: in the short run, the market is a floating machine, but in the long run, it is a weighing machine. So, in conclusion, the efficient market hypothesis is a fundamental theory in finance that has shaped our understanding of how financial markets operate. While EMH provides valuable insights into market efficient and investment behavior, it is not without its criticism and limitations. As investor and analyst, it's essential to critically evaluate the implication of EMH while remaining cognizant of market anomalies and behavioral biases. Okay, so that's our presentation about efficient market hypothesis, and thank you.